Welcome back to my channel. This is Deferred Tax FAQs part 1. So I'm hoping to do a series on deferred tax questions that you may have. If you have anything you'd like me to answer in a video, then please drop the question below in the comments, or you can email me any questions directly. So the first question is it's about where we recognize deferred tax. So deferred tax arising from owner-occupied land, investment property, buildings, and vacant land. So the question here specifically is, when do I use OCI and when do I use profit or loss when calculating deferred tax? Now, this is a common confusion with students, and I always like to say the problem with deferred tax 9 out of 10 times is not deferred tax itself, it's all the other stuff. And I think this is an example of one of those types of questions because there's actually a pretty simple principle in IAS 12 that we need to understand, but that principle hinges on you understanding a lot of other work that you would have covered before. So what is the key principle here in IAS 12 that we need to understand? So the thing that we need to understand is that we have certain transactions that will give rise to tax. And the principle is that wherever the transaction goes, so whether it be P&L, directly in equity, or OCI, there the tax must go also. So the tax follows the transaction. Now, if we think about what is being mentioned in this question, so owner-occupied land, investment property, buildings, vacant land, etc. When we're trying to make a distinction between all these sorts of things, we have to ask ourselves one thing, okay? With regards to this land or property, or whatever the case may be, what is the intention of the business? So the intention of the business is going to drive the classification, okay, of the asset. So if the asset, so let's say we have land, okay, and the intention of holding that land is for capital appreciation, for example, then that land would be investment property, okay? If we have that land, and the purpose of the land is that we are going to build our head office, or that we've built our head office on the land, then that land is going to be PPE. So when we're trying to understand how we're going to account for deferred tax, it's very important that we first determine whether it is investment property or PPE. Because once we can figure out whether the land or building is either one of these, then the deferred tax and where to recognize it becomes relatively easy. Okay, so why does it become easy? Because if the asset is investment property and it is on the fair value model, then that means that all of the fair value adjustments would go through profit or loss. So if all of the fair value adjustments go through profit or loss, then what's hiding over there as well? The tax. So the tax would also go into profit or loss. Now let's say that the land and buildings, or land or buildings, it's classified as property, plant and equipment, and it is measured on the revaluation model. The revaluation model, we know that when we revalue our assets in terms of IAS 16, it is going to go through OCI. The gains and losses go through OCI, and then they eventually close off to a surplus in equity. So if the gains and losses then go through OCI, what's waiting right there? the tax. So then the tax is going to go through OCI as well. So the important thing about this question that you need to understand is that we first have to try and unpack what the underlying asset is classified as. Once we know what it's classified as, we have to think about where the gains and losses are going to be recognized, and if those gains and losses give rise to deferred tax, then we would recognize the deferred tax where we recognize the gains and losses. Okay, next question. Permanent differences. So let's talk about permanent differences. The question here is, would you fully exempt something that SARS doesn't grant allowances or deductions on and regard it as a permanent difference or not? So SARS is the South African Revenue Service. Okay, so let's unpack this question. We are given a full exemption from SARS. Okay, so there's no allowances, no deductions, and it is so basically that means that over the life of the asset, SARS is not going to give us any sort of deduction. The question is, would we regard that as a permanent difference or not? Now, when thinking about this concept called permanent, okay, difference, okay, I always want to think about permanent in relation to what? Now, when else have we heard a term involving this word, difference, okay? When we were doing deferred tax? Well, where we heard it was when we spoke about temporary differences, okay? Because in terms of IS 12, we need to provide for deferred tax on our temporary differences with certain exceptions. Now, temporary differences, let's think about what those mean. Those mean that there are differences between how something is being treated from an accounting perspective versus how it's being treated from a tax perspective, but those differences are temporary because over time those differences will go away, and the net effect on the accounting profit and then would be the same as the net effect on the tax profit. Okay, so there's a difference at a point in time. It's temporary because over the life of the asset, that difference is going to correct itself. Now, if we want to think about what a permanent difference is, a permanent difference means that there's a permanent difference between our accounting profit and our tax profit. So from an accounting perspective, if we are going to expense this asset over its life, and okay, so that means that our accounting profit over the life of the asset is going to decrease because of the expense. However, from a tax perspective, we're never going to be granted any allowances, which means that my tax profit is never going to be impacted by this asset. So even over the life of the asset, there's no allowance or deduction that we can claim for this asset, which means that the difference between my accounting profit and my tax profit is actually never going to reconcile. Okay, they are always going to be different, and therefore that is what we would call a permanent difference. So if there are going to be no allowances granted on this asset over the life of the asset, then we would think of that as a permanent difference. Okay, next question. Allowances greater than the carrying amount. Now, how do we calculate the tax base of something that is granted an allowance of 120% over 4 years? So this is quite a nice one to think about. So let's imagine we have this asset over here, and for this asset, the revenue service is going to give us 120% as a deduction. Okay, now when we're trying to calculate our deferred tax, how are we going to go about this? Okay, so let's think about the principle. Our deferred tax is going to be calculated on the assets and the liabilities currently sitting in our statement of financial position. So in the statement of financial position, we have this asset, and let's say the carrying amount of the asset is 100, okay? We're going to have this asset of 100. Now, what is its tax base? Now, when we think about the tax base, there's actually two things that's going on here. Firstly, we are going to be given an allowance for the full 100, but we are also actually being given an allowance over and above the cost of the asset. So if we're just looking at the asset itself, right, this 100 over here that's sitting on the statement of financial position, we can say that our future deductions here are going to be 100. Okay, so if the economic benefits are taxable, then the tax base becomes the future deductions. So we know that for this 100, the full 100 is going to be deducted. So at initial recognition, there's no temporary difference over there because the two are equal. However, we've still got this extra deduction. So this extra deduction is sitting over there at 20. But in the statement of financial position, there's no corresponding amount to recognize this additional benefit that we are getting from the revenue service. So that means that at initial recognition, okay, we effectively have a temporary difference, right? Because if you take the 0 and you subtract the 20 from that, that's going to give rise to a temporary difference. Now that is a temporary difference at initial recognition, and we would need to think about whether or not our para 15 exemption would apply in that case. So that is a permanent difference, okay, because there's never going to be anything on the statement of financial position, okay, for that asset, for that additional deduction, and so there's a permanent difference between accounting and tax. So I would say that in that case we have a para 15 exemption for the additional deduction that we have received. Next question. So the next question is on dividends and deferred tax. Okay, so we have a dividends earned of 58,000. So 58,000 is our total dividends. Okay. Now, it says 20,000 was from an investment in a foreign company. So this means that 20,000 of those dividends are actually classified as foreign dividends, and the remaining 38,000 would be local dividends. Yes, so it's important to understand that our total dividends of 58,000 is made up of 20,000 foreign and then 38,000 local dividends. Now, dividends received from foreign companies are fully taxed in the year that they are earned. So these are fully taxed. Okay, fully taxed. So what is the impact on our disclosure? Okay, so let's think about this one. Now, if we think about the dividends, okay, what is going on in my statement of comprehensive income? In the statement of comprehensive income, I've recognized an income of 20,000. So when I think about my tax calc, okay, in my tax calc, I have, I'm going to start with my profit before tax. Included in the profit before tax would be the foreign dividend, okay, and that foreign dividend is fully taxed. Okay, so it is fully taxed. Now, if you think about our deferred tax disclosure, okay, in my statement of financial position, is there anything relating to this foreign dividend? Well, no, we're going to assume that these dividends have already been received in cash, so there's nothing sitting in the statement of financial position, which means that there's no deferred tax, okay? On an intuitive level or a common sense perspective, why is there no deferred tax? Because the accounting treatment and the tax treatment is exactly the same. We are recognizing the income, and as we recognize the income, it is being taxed, so there's no difference between accounting and tax. However, if we think about the local dividends, so these local dividends are exempt. Okay, they are exempt from tax. And so the question becomes, what is the impact of those local dividends? So if I think then about my tax calculation, in my starting point as well, I'm going to have my local dividends. Okay, but those local dividends are not going to be taxed, so I would need to adjust for the local dividends to exclude them from my tax calc. So they are excluded from my tax calc. Now again, what's sitting in the statement of financial position? Let's just assume that this was paid in cash, so we don't have to worry about that for now. Now, what impact is this going to have on my disclosure? Well, this example is going to have an impact on my tax rate recon. Okay, tax rate recon. Now, think about why it's going to have an impact on the tax rate recon. The tax rate recon, my starting point is my profit before tax multiplied by the tax rate. Okay. Now, in my profit before tax, I have the local dividend, right? But in my actual tax expense, my actual tax, which is the current tax plus the deferred tax, okay, what is there relating to this local dividend? Well, the local dividend is exempt from tax, so there's no current tax, and there's no there's nothing on the statement of financial position for the local dividend, so we didn't account for deferred tax. So in my starting point, I've got the local dividend, but it's not in my end point. That means that I must have a reconciling item to account for the fact that I have this local dividend of the 38k, and I'm going to multiply that by the rate, or however you're adjusting. Now, why does the foreign dividend not come into effect here? Because think about it. The foreign dividend is sitting in my starting point. So over there, I have the foreign dividend. But the foreign dividend is also sitting over there in my current tax, right? So it's in my starting point. It's in my end point. So I don't need a reconciling item. Okay, so I think maybe some of the confusion with this question was with regards to just to understanding that the 58,000 consists of both foreign and the local, and making the distinction between the two amounts. Okay, so I hope that FAQ, this FAQ video has been useful for you. And like I said, if you have any questions, post them in the comments. Or you can email me directly. Make sure to like and subscribe to the channel, and I will see you in the next video. Bye bye.